Hi, this is Matt Carbray, Ridgeline Financial Partners. This is Matt on Money. We're actually going to switch things up a little bit this month. We put something out there in social media to see if anybody had any questions, and we had some great questions that came back. So, in today's episode, we're going to talk about a couple of different themes. One question that came in was to remind everyone of the contribution limits specific to retirement accounts, various workplace accounts, retirement accounts such as individual retirement accounts that you may fund individually. Roth IRAs also would fall in that category. We'll talk about health savings accounts. We'll talk a little bit about dependent care accounts as well, which is something that's often overlooked but certainly available with a lot of employer plans. We'll talk a little bit about the market volatility, inflation, interest rates, all of that in this month's episode of Matt on Money. Okay, where we'd start today is we had a great question that came in from Russ, and the question was, well, Matt, all too often I get a little bit confused about the various different contribution limits. And Russ, you're not wrong. The contribution limits are slightly confusing. And also, can I do this if I do this? And a lot of it has to do with the income that you have at either an individual or a household level that's going to dictate what you can and cannot do, especially if you're someone who participates in a employer-sponsored plan, such as a 401k, a 403b, or a 457 plan. But as a reminder, in the 2022 tax year, the amount that can be contributed for those of you that are not yet the age of 50, so you will not turn 50 this year at any point, that contribution limit into a 401k, 403b, or 457 plan is $20,500. For those of you that are going to turn 50 or have already turned 50, that contribution limit is $27,000. So we call it the catch-up contribution. It's $6,500 that gets added to that $20,500. So that's the contribution limit, and we'll see what happens for 2023. They say that they adjusted for inflation. Well, inflation's pretty high right now, so perhaps we're looking at higher contribution limits next year. For those of you that also contribute to IRAs, individual retirement accounts, the contribution limit for those is $6,000, again, under the age of 50. Over the age of 50, it's $7,000. Two other, I think, important contribution limits that you all should be aware of. For those of you that are in a high deductible health plan that has an HSA, a health savings account, an amazing vehicle, and we can do a whole another segment at some time to talk about the wonderful benefits of an HSA, but that contribution limit is $3,650 for single participants. If you have a family, it's $7,300. If you happen to be over the age of 55, there's a catch-up, which is $1,000 per person. So some really good contribution levels for those of you that are saving for future healthcare expenses or even current year healthcare expenses. Why not get the tax deduction by putting that money into the health savings account to pay for the things that you were going to pay for anyway? And then last but not least is the dependent care FSA, flexible spending account, for those of you that have children and are paying for any of the expenses that are associated with their care. The contribution limits for a single tax filer is $2,500, and for those of you that are filing a married return, it's $5,000. So keep those contribution limits in mind. Important for you to know what they are and what it is that you can take advantage of. Well, it would be not right for me to overstep the whole inflation conversation, right? So we're all dealing with inflation right now, and inflation is widespread. So when we think about the cost of goods and services that we consume as individuals, you don't have to go much further than your grocery store to see that that is certainly at play. And when we talk about other sorts of inflation that we all have to deal with to varying degrees, you talk about energy inflation. You talk about what it's costing right now at the pump. So inflation is certainly a concern, and it has not subsided. I mean, there were thoughts that this inflation was more transitory, if you've heard that word that's been put out there by people in the financial profession or people at the government level. Well, it hasn't proven to be too transitory. What we've seen is that inflation has persisted, and if anything, it's actually been going up. So when inflation is calculated, they are looking at the private inflation reading, and they are comparing it relative to that. So when we see inflation in the 7%, in the 8% range, that effectively means that inflation is running at a very high level. So with that being said, what do we expect to happen over the next couple of years? Well, it's hard to imagine that we will continue to be in as high of an inflation environment as we're in. And the reason I feel pretty strongly about that is the Federal Reserve, which controls monetary policy, is doing certain things in an attempt to curb inflation. Now, it won't have an immediate impact, but by them raising the Fed funds rate, the rate that a lot of interest rates are tied or pegged to, it's effectively going to make the cost of borrowing higher over the course of time. So do I expect inflation to be at these levels forever? No. Do I think that we're going to still have a fairly high level of inflation for the next 6 to 9 months? Yes. Do I think we're going to get back to historical inflation levels, which are below 3%? Not anytime soon. But I do think that we are in for a lower inflationary environment as we start to get into 2023. Okay, so for those of you that have been following me, and thank you for doing so, you've had some tremendous questions. And a lot of the questions that I get are, okay, Matt, so you've told me about inflation. I know it's real. I'm living it. What are some of the things that I can do to make maybe a small little dent in that? And I've been talking about these Series I bonds for quite some time, which are purchased through the U.S. Treasury. These are U.S. government 30-year bonds. And what I like about them is that there's a set base rate, and then that rate is also, there's an inflationary factor that is put into that rate. So I was back in December talking about the benefits of I bonds, and at that time, I bonds were paying 7.12%. Now, when you think about U.S. government debt, it is often viewed as being one of the more secure, I don't want to say risk-free, but I want to say one of the higher rated type of debts that one could invest in. So we've now seen that Series I bond rate actually increase, and I think it's now in the 8s. One thing to really be aware of is that you have to understand that there are certain holding period requirements, whereas if you don't hold the bond over that duration, they will take back some of the interest that they otherwise pay you. But the challenge that a lot of us have is if we're sitting on any sort of cash, which is normal, I mean, all of us to varying degrees will sit on some level of cash, what is it earning us? And if it's earning us 0% in the bank and inflation is running at 7 or 8%, then effectively the value of our dollars is losing value. I mean, we call it the loss of purchasing power. Over the course of time, our dollar is going to continue to be worth less and less as inflation continues to run. So Series I bonds, great tool, something to look into, understand all the provisions associated with it. Unfortunately, it's limited to $10,000 per person, but in a household setting, you could have $10,000 in your name, $10,000 in a spouse's name, and $10,000 in each of your children's names. If you own a business and have various different entities, you can also do the same. So a good way to maybe put some of your cash to more productive usage, try and keep up with inflation. We fully understand at Ridgeline Financial Partners that this is a challenging environment, and we don't take our responsibility lightly. So if you have concerns, if you want to talk things through, if you're not a client of ours and you follow us and you're trying to better understand what's going on with your investments, what's going on in the world, please feel free to reach out to us. We continue to try and provide you timely information that you can use to improve your situation and improve your level of intelligence as it comes to financial planning. So thank you so much. Great to see you all. Hope you're all staying safe and healthy. We'll see you again next month's Matt on Money.